Hello and welcome to the 13th iteration of the massive open online course for the University of Nicosia. I'm your teacher, Andreas M. Antonopoulos, and I'll be answering questions for session 2, week 2 of the Byzantine Generals problem. We're going to be talking about halving, mining, and various mining and currency issuance related topics for this session. But it's a topic we're also going to be revisiting in future sessions. So let's see what we have here. I'm going to make sure we have good audio. And we'll get started right away. Thank you for joining me. As always, we've got some great questions that you've asked in the forums. It's been a fantastic week. I know you've all been studying hard and you've given me some great questions to answer. Let's get started with a question from Marcel. Marcel says, every 210,000 blocks, the reward for finding a new solution to the hash puzzle and mine a block is cut in half. Now, currently, the reward is 12.5 BTC, while somewhere in May 2020 it will be halved to 6.25 BTC, 6.25 Bitcoin. When reading about the financial consequences for miners, there seem to be two mainstream opinions on the consequences for the halving that happens every 4 years. The first argues that as the supply of newly minted Bitcoin halves, the price of Bitcoin must go up so that mining will stay profitable and even more miners will come in so the network strengthens. The other argues that many miners will withdraw from mining, mostly because of expensive electricity areas, because they will make a loss while continuing to mine, so the network will be weaker. What is your opinion on this? Well, first of all, it's important to realize that the difficulty of mining does not depend directly on the price. However, it does reflect the price because the price of Bitcoin determines the profitability of miners, together with 2 or 3 other factors, the biggest of which is the cost of electricity that each miner faces. The second biggest is the efficiency of the mining equipment, or ASICs, that they're using to mine. So, you've got to think of miners not as a monolithic block. There are thousands of mining businesses out there with hundreds of thousands, millions of mining ASIC equipment rigs, and all of these miners have a variety of profitability metrics. So some of these miners are very profitable, some of these miners are barely profitable. And this depends on how much they pay for electricity and on how efficient their mining equipment and their general operation is. Now, in many cases, miners pay for electricity in blocks, and they buy electricity months and months in advance, so that they're not influenced by short-term fluctuations. Now, I think both of these opinions have some validity to them. We may see both of these scenarios play out. We may see a reduction in the number of miners participating in mining, and therefore a reduction in the overall hash power of the network as some miners become less profitable. However, keep in mind that as some miners become less profitable because they have lower electricity and the mining hash rate goes down, in 2 weeks what that does is it causes a mining difficulty adjustment. And what that does is it makes the remaining miners more profitable because mining gets easier. So those who have lower electricity costs and more efficient equipment will become more profitable and may then decide to introduce new equipment and increase their hashing power in order to take advantage of this profitability, basically expanding their operation, which causes hash power to go up again. So when hash power, or profitability rather, when profitability declines, what that does is it clears out the least efficient miners and it makes the most efficient miners slightly more profitable because the difficulty adjusts. From an economic perspective, of course, when you have a commodity like Bitcoin that has pricing that is dependent in many ways on supply versus demand, and the supply is reduced by half, that has an effect on the market. Because the supply is reduced by half, but presumably the demand stays more or less the same, that means that less Bitcoin is going to be arriving on the market. Most miners sell a majority of their Bitcoin, if not all of their Bitcoin, as soon as they earn it, in order to pay mostly their electricity costs and take profits, because their electricity costs are paid in a national currency and not in Bitcoin. Which means that on an average day, as 144 blocks are being mined, that's putting several thousand Bitcoin onto the market in terms of supply that must be sold to pay for electricity costs. When that supply is divided by half, and half as many Bitcoin are available on the market, if demand remains the same, that will necessarily push the price of Bitcoin up. More buyers chasing, or the same number of buyers chasing less Bitcoin, will drive the price up. So I think we're going to see both of these happen, and they might happen on different timescales. So for example, in the immediate short term, you might see people reducing their mining activities and a small drop in the hash rate. I don't think it's going to be a dramatic drop. And keep in mind, even if hash rate drops by 30%, that would only put it to the level that it was this past summer, because it's grown so much over the last several years. In fact, it's been growing at a tremendous rate since 2013. And at some point, I think there's going to be a reflection in the price, and the price is likely to go up because of reduced supply. But, you know, economics is not my field, so I don't know how that's going to play out. We'll have to see. The important thing to remember is that this is a highly dynamic system with many dynamically adjusting parameters. And I think it's unlikely we're going to see very, very large fluctuations in the long term. This market stabilizes dynamically because of the dynamically allocating algorithms, such as the difficulty retargeting algorithm. And the other thing to remember is that miners are not surprised by this. They've been anticipating this since the very beginning. They know exactly when Bitcoin is going to do its halving, and they've known for years. So they have every opportunity to incorporate this into their financial planning. It's unlikely that they're going to wait until the very last second to decide to turn off equipment, and it's very unlikely that their prices of electricity are negotiated on a day-by-day basis. So if they're going to be unprofitable, they're going to turn off their mining earlier and not go into unprofitability. All right, the next question comes from Brandon. What is the long-term strategy and incentives for nodes on the network to continue performing proof of work of transactions after the final supply of Bitcoin is mined? This is a question I get all the time. What happens after 2140? This would assume that people would still contribute resources without the opportunity of receiving anything in return. Do you think improvements in hardware will drive prices low enough that a collection of future block transaction fees exceed the energy needed for proof of work? If this is the case, would it not also decrease the number of miners volunteering their resources to do proof of work down to the point where coalition of hashes or 51% attack scenario is more likely to arise? Brandon, this is a moving target. It doesn't happen suddenly in 2140. The incentives are constantly being rebalanced by miners every single day. And in fact, the reduction in supply is much more dramatic at this point as we see Bitcoin drop from 12.5 to 6.25 Bitcoin. And the next couple of halvings, long before we start seeing the Satoshi-based block subsidies. So fees are going to exceed the block subsidy part of the reward long before 2140. In fact, they already did briefly in 2017, and they're likely to do so again in 2020. In a large number of blocks, we're going to start seeing fees are equal to the block subsidy. So from that perspective, as the economics change, miners adapt to the new profitability. In the long run, the general idea that Satoshi even expressed in many of his writings was that fees will eventually pay more than the block subsidy, and that's how the network will operate. Now, in order for that to happen, you either need very expensive fees on a few transactions, or you need a lot of transactions with relatively low fees. And the balance there is going to be crucial. So I think we're going to see more transactions happening, and we're already seeing that the amount of transactions that can fit into a block has more than doubled since 2017. As that happens, that means that the fees contributed by each transaction don't need to be as high. The other big development, of course, in that space is that a lot of the transactions will gradually move off-chain. And off-chain has two real destinations. One destination off-chain is in the private databases of custodial exchanges and other such entities that do their own bookkeeping in a SQL database. That's, of course, not a model where you don't have to trust a third party. It's a model where you have to completely trust the third party, and that's risky and not a healthy model. The other, of course, off-chain destination is the Lightning Network, which we'll be talking about more in future sessions. So if more of the retail transactions and all those small transactions are happening on the Lightning Network, and the majority of transactions that are happening on-chain on the Bitcoin blockchain are very large transactions, large in amount, and transactions for opening and closing channels, which again will be large in amount, then those are likely to have slightly higher fees, but contributing to the health and security of the network. On the topic of coalition of hash power leading to a 51% attack, let's explore that topic a bit further. Martin asks, is there a mechanism or watchdog that can prevent a future coalition of hashing power to reach 51%? Recently, for example, we've seen some countries heavily investing in cyber warfare. If they transition this cyber warfare into the blockchain space, and in that scenario, a government-backed coalition of hashing power was to attack the Bitcoin network, are there mechanisms to stop this? There are no mechanisms to stop this that don't shift dramatically the power of consensus into some other power center. The real question here is who has ultimately the power to make decisions on how the network consensus rules work and the allocation of transactions in blocks. Proof of work is a very decentralized system that allows for a very robust mechanism of security, and it takes a lot of effort and a lot of money to attack that with a 51% attack, and the benefits of a 51% attack are marginal. So what are the alternatives? The alternatives are not to make a committee of 12 developers, because then what you need in order to attack that is only 7 people to agree with each other rather than thousands and thousands of miners. So from that perspective, that's a weaker mechanism for enforcement. You've got to realize that consensus in the Bitcoin system emerges from the activities not just of miners, but also of the economic activity and economically important nodes that operate on the network, which also validate transactions. They cannot resist the 51% attack, but they can take countermeasures against the coalition of miners, including the ultimate countermeasure, which is a change in the proof of work algorithm, which is almost like the nuclear weapon of proof of work countermeasures. Now, such a change would be enormously disruptive to the network, of course, but it would also invalidate the enormous investment in hardware that a coalition of hashing power might take in a hostile environment, not only making that 51% attack worthless, but also making all of the investment they've made in that equipment worthless by changing the algorithm. And again, that is always an option, and knowing that that option exists, that an adversary here may end up spending billions of dollars in order to commit an attack with very little reward, and that attack effectively being dismantled by a change in the proof of work algorithm is a good reason why you don't even start that kind of attack, because ultimately it's ineffective. Matthew asks on a similar topic, will the advent of quantum computers affect the hash rate of Bitcoin or the speed at which Bitcoins are mined? Could it affect or bring forward the date of the last Bitcoin is projected to be mined from 2140? Okay, let's start by answering this in reverse order. Can an increase in the speed of Bitcoin being mined bring forward the date of 2140? Not really. And the reason for this is because if blocks are mined faster than 10 minutes, what happens next is in 2 weeks, on average, the difficulty retargeting algorithm readjusts the difficulty. So if quantum computers made it much, much easier to mine blocks and blocks were coming out at a much greater speed, that would only last 2 weeks. And at the end of this 2 weeks, the difficulty would be readjusted, and the end result would be that blocks would come out again at 10 minutes, now incorporating into the equation the time it takes for a quantum computer to mine a block. So from that perspective, increases in mining capability or hashing power through the use of quantum computing would simply trigger the difficulty readjustment algorithm and wouldn't result in the Bitcoin being issued faster than the normal issuance rate, except for that brief period of 2 weeks when they would be a bit faster. And then you'd have a readjustment. But the other thing to keep in mind is that the algorithm that is used for mining, the SHA-256 hashing algorithm, is not an algorithm that is easily susceptible to quantum computers. Quantum computers do not dramatically improve the hashing algorithm SHA-256, at least as far as we know today. So while some algorithms that are used in Bitcoin are in fact very susceptible to quantum computers, the best example being the elliptic curve digital signature algorithm and the derivation of private and public keys, is that algorithm, the elliptic curve itself, is based on the difficulty of what's called the discrete logarithm problem. And the discrete logarithm problem is the factorization or the ability to reverse a multiplication in a prime field of the elliptic curve modulo that prime. Now, that problem is very difficult for classical computers. Effectively, it's equivalent to a brute force attack, meaning you have to try all possible combinations. But it is almost trivial for a quantum computer as long as that quantum computer has enough bits. So if you had a quantum computer with enough bits to do an attack against the discrete logarithm problem, digital signatures and public keys would be vulnerable in Bitcoin unless we change the signing and public key algorithm, which of course would be a very good idea to do. But hashing, especially the SHA-256 algorithm that's used in mining, is not susceptible to a quantum algorithm that dramatically improves the speed at which you can do hashing. So mining is not the concern here. The primary concern for quantum computers is the security of digital signatures and private keys on the elliptic curve. And that would have to change if quantum computers got fast enough or capable enough to do discrete logarithm on a 256-bit field. Let's go to a more basic question and a more practical question now. Jean asks, how is the number of zeros that are the beginning of the target hash, how is that determined? So effectively, the number of zeros is the difficulty because the more zeros you have at the beginning of the target hash, the harder it is. If you think of the target hash as a number, the more zeros in front of it, the lower that number is. And as the number gets lower, it's harder to pick randomly a number that is below it. So think of this as a bar that starts out as a number that has 77 digits. So think of 999999 times being the maximum possible number you can fit in 256 bits, and that's that bar. Now, if you're picking random numbers, the chances of you coming underneath that number is pretty good. So it's easy to find a number underneath that high bar. Now, if instead of 99977 times, it's 0,99977 times, now that's 10 times lower. Now we're doing this in binary, so it's actually cutting it in half. So now the bar is halfway down. Now when you're picking random numbers, half of them are going to fall above the bar. It's twice as difficult to find one that's below the bar. Now, you put another zero, binary zero in front, now that number is half as much. Now, 3/4 of the numbers you pick randomly are going to be above the bar. It got more difficult. And so that's what the difficulty means in mathematical terms. Think of it as Bitcoin miners trying to do the limbo. And the limbo bar keeps getting lower and lower and lower. And the reason this happens is simply because the hashing algorithm is like picking randomly, so you get a random result in the entire 256-bit range. And as the top of that range gets lower by half every time you make the first digit 0, and you keep adding 0 binary digits to the binary number, that means that the number gets half as big. And as a result, you have a half as big target where you need to land your random guess, and that makes it twice as difficult. So, the difficulty target is determined, the difficulty target is this number. Now, how is that number determined? And the way the number is determined is by pegging it to the 10-minute block time. So the difficulty retargeting that happens every 2 weeks says blocks should take 10 minutes. 2016 blocks have elapsed since the last time we checked. Those 2016 blocks should have taken 10 minutes each. Therefore, the total amount of time since our last difficulty retargeting should be 20,160 minutes. So 2016 blocks times 10 minutes, 20,160 minutes. How many minutes have actually elapsed? Well, if 22,000 minutes have elapsed, then blocks are coming out too slowly. And what we do is we divide 22,000 by the expected number, 20,160, and we then adjust the difficulty proportionately by that number and reset the difficulty algorithm. And that calculation happens in exactly the same way on every single node that participates in the network, on the exact same block, the 2016th block in a row, and determines the difficulty for the next most block, and everybody gets the same answer, because if they count from the timestamps in the box the total elapsed time of the last 2016 blocks, they're going to get the same answer. If they multiply that by the expected 10 minutes, they're going to get the same answer. The amount that actually elapsed is going to be the same answer. If they divide the two, they're going to get the same answer. And if they multiply the previous difficulty by this new adjustment factor, they're going to get the same answer. So thousands of nodes all around the world at the exact same block height do the exact same equation with the exact same inputs and arrive at the exact same answer, which tells them what the difficulty will be for the next block, and everybody knows what the answer is. So if the next block doesn't come in within that difficulty, it's not valid. And miners know what number they need to reach because they've done the exact same calculation. So that's how the target hash is determined. Idongasit asks, can two miners compete to verify a block in 10 minutes? Yes. Thousands of miners compete, but two miners can succeed simultaneously. In fact, more than two miners can succeed simultaneously. Now, the chances of two miners succeeding simultaneously or almost simultaneously are pretty low. Keep in mind that it only takes about 5 or 6 seconds for a block to travel all around the Bitcoin network, and everybody knows that a new block has been found. So for two miners to simultaneously find a valid block, it has to be within 5 or 6 seconds, because the moment a miner sees that somebody else has found a valid block, they give up and they immediately start trying for the next block because they don't want to miss any time in this race. Let me explain that again. The moment everyone knows that a block has been found, a valid block, that is like the starting gun of the race for the next block. And you want to start as quickly as possible after the starting gun goes off. In Bitcoin, the starting gun is the fact that another valid block has been found. That circulates around the network in about 5 or 6 seconds. Now, what happens if, when a miner finds a block, and before that block has been seen by everybody else, another miner somewhere else in those 5 or 6 seconds also finds a valid block and starts telling everyone? Well, in that case, something interesting happens. Two parts of the network, two different segments of the network may hear about a valid block at different times from different miners. So let's say you have miner A, who's in Australia, and you have miner C, who's in Canada. And within the same 5 or 6 seconds, they both find a valid block and they start telling all of their neighbors. Now let's imagine that the Bitcoin network was organized by geography. It isn't exactly, but let's take that as a simplification. So Australia, Japan, China, Indonesia, the Philippines, parts of Africa, and half of Europe hear the Australian block first, and then a few seconds later they hear the Canadian block. Because they hear the Australian block first, they assume that that one won the race, and so they adjust their blockchain to show the Australian block as the winner. Meanwhile, all of the Bitcoin nodes in Canada, North America, United States, Mexico, South America, and the western half of Europe hear the Canadian block first. And because they hear the Canadian block first and a few seconds later they hear the Australian block, they assume the Canadian block won the race. So they build a blockchain with a Canadian block as the winner. Now you have two different blockchains, and that's called a fork. Now this is a special kind of fork called a consensus fork. So for a brief minute you have the same parent, and you have the Australian block and the Canadian block both forming perfectly valid chains. Half the network believes this one won, half the network believes that one won. How long is that going to last? Well, it's only going to last about 10 minutes until the next block is found. And the way this is resolved is based on the consensus algorithm. It's really quite simple once you think about it. Everybody who thinks the Canadian block won, including all of the miners who are in Canada who saw that block first, will immediately start building another block as the child of the Canadian block. And all of the miners who thought the Australian block won first will immediately start building a child block with its parent being the Australian block. So both sides will try to extend the blockchain off their corresponding tip from the consensus fork. At that moment, as they go into that race, someone's going to win. And it's very unlikely that two miners are going to find a valid block simultaneously within the same 5 seconds again. More likely, one of the two sides is going to win. Let's say that the side that heard the Canadian block first is the one that extends the chain. They then publish a new block that is the child of the Canadian block that won the race before. Everyone on the Australian side now sees that there is a longer chain, and not just a longer chain, but one that doesn't include the Australian block as its parent, instead has this other Canadian block. And because that's the longest chain by difficulty, the greatest cumulative difficulty chain, that chain wins. And as a result, all of the nodes that had the Australian block as the tip of their blockchain will reorganize. They will drop the Australian block, that's called orphaning. They will take all of the transactions and re-queue them in the mempool if they're not included in the Canadian block, and they will continue processing, with the blockchain now being the one that has a Canadian block as a parent. So effectively, the fork is resolved within one block automatically. These types of consensus forks happen on average once every 1 or 2 weeks, and they're a normal process of the proof of work consensus algorithm. They're called orphans. And these types of orphan blocks happen, as I said, once every 2 weeks. This is the reason why the time limit is 10 minutes for finding a block, or the target is 10 minutes for finding a block. Satoshi Nakamoto could have picked any number. They could have said, let's have blocks every 1 minute, and made an appropriate adjustment to the reward there. But if they had blocks every 1 minute, then the number of simultaneous discoveries of blocks would go up. So you'd have more orphan blocks than we do today. And so 10 minutes is, or at least according to Satoshi, was at the time the ideal number of minutes to wait. Not too many minutes, but not so few that you end up having a lot of orphan blocks because people are finding blocks simultaneously. All right, let's get a quick audio video check. Let me know if you're having any problems with the sound or the video, and we'll continue to the next question. Thomas asks, what has to be done to roll back 10 blocks in Bitcoin blockchain? Can the power needed be calculated? What can an attacker do if they were successful? Thomas, that's a great question, and that question comes up very, very often. First of all, yes, you can calculate the amount of power, and in fact, you can even calculate the amount of money needed based on an estimate of the cost of electricity to roll back 10 blocks. So there are websites out there that will give you an estimate of the cost of a 51% attack. If you do a search for cost of 51% attack, you will see websites that keep a running tally, not just for Bitcoin, but also for many other proof of work chains. Last I looked, which was actually a couple days ago, a 1 hour 51% attack, which sustained would result in a 6 block rollback, would cost about $900,000 to pull off. So about $1 million to do 6 blocks. I'm assuming that means that for $1.4 million or $1.3 million, you could do 10 blocks of sustained attack. That means that it will cost approximately $15 million to $20 million to do 144 blocks, so 1 day of changing of the Bitcoin history. It would cost $30 to $40 million to do 2 days, et cetera, et cetera, et cetera. So this is a very, very expensive type of attack. And of course, you would have to not only be able to sustain an attack like that for this period of time, which means keeping your coalition together. And this becomes an intensely political fight because the opposition is not going to simply sit still and take it. There will be a lot of activity to figure out why this is happening, who's benefiting from it, and to try to find a way to thwart this kind of attack. And there are a number of countermeasures that can be taken against this kind of attack. But in any case, you still have to keep your coalition together because for the times that the miners are doing this, they're taking a very, very big risk. And the risk is, of course, that if this attack fails, they will have wasted this money for nothing. Keep in mind that when you're doing this kind of attack, you're making the block reward, but if your transactions are being blocked in exchanges, for example, or if the other coalition manages to win and rolls back your blocks, then you lose the block reward, but you've still spent the money on electricity. A much lower risk solution is to simply mine honestly, and then you simply earn the reward to pay for your electricity. So it's a very high risk type of attack. What can you actually achieve if you're successful? This is very important to remember. If you achieve a 51% attack, you cannot steal Bitcoin that you don't have private keys to. You cannot publish transactions that are invalid. You cannot publish blocks that are invalid, and you cannot change the rules of consensus. These things are not possible with a 51% attack. The reason they're not possible with a 51% attack is because miners are not the only ones checking the validity of the rules. Every node checks valid transactions, valid blocks, valid signatures on every single transaction that flows through the network, and every node will reject an invalid signature, an invalid transaction, and an invalid block. As a result, if you try to publish that while doing your 51% attack, what you do is you fail with your 51% attack. Honest nodes will accept the 49% block that is valid and ignore the 51% block that is invalid. Let me say this again. Honest nodes will accept the 49% block if it's valid, if the 51% block is invalid. But even further, honest nodes will reject the 99% invalid block and accept the 1% valid block according to the consensus rules they're following. Which means that if you try to mine adversarially like this, you cannot produce invalid blocks, transactions, or signatures because you end up losing the race. Furthermore, if you try to change the rules and you fork into a new coin, as we've seen happen in the past, then you have to sell this new coin on exchanges, and you have to persuade exchanges to list this new coin, and you're probably not going to get the same price for this new coin as you would get for mining Bitcoin. So in the end, you end up mining 12.5 Bitcoin per block, but if you change it so it's not Bitcoin anymore, that 12.5 coin is not worth the same amount of money, but the electricity you wasted doing this is worth the same amount of money. 51% attacks can primarily do two things. One, they can implement censorship on the network by refusing to mine specific transactions. Now, in order to do that, they have to sustain the censorship, meaning that the moment they stop censoring, or the moment they stop doing a 51% attack, or the moment the 49% side is able to mine one block, they're going to include the transaction that the 51% side was trying to censor, and the censorship has failed. So you have to not only sustain a 51% attack, but you have to sustain it in a way that no other valid block is recognized. And that takes a lot of luck as well as a lot of money. Secondly, 51% attacks can do double spends. Now, in the case of double spends, what that means is that a miner who is doing a 51% attack, or a coalition of hashing power that is doing a 51% attack, can spend Bitcoin that they already own, and only Bitcoin they already own, with a transaction, and then they can double spend that transaction later to a different address. Now, if exchanges accept that transaction, for example, and withdraw that money, or pay miners that money in the national currency or in another cryptocurrency or something else, and then miners double spend that transaction so it doesn't actually get deposited to the exchange but instead goes back to the miner's wallet, then effectively the exchange has paid out money and not received Bitcoin in return because the chain has been rewritten. That will probably only work once. And the reason it will only work once is because the moment there is a rollback of 6 blocks in order to double spend a transaction, exchanges will immediately increase the number of confirmation they need on deposits, probably quite dramatically, or they're going to freeze withdrawals until the network stabilizes again. So you have to do it once, and you have to do it with a pretty big transaction. And keep in mind that miners can't spend their mining block subsidy for 100 blocks, precisely to prevent them from doing this. So they may be able to spend prior block subsidy, but then they can't double spend that transaction easily, right? Because its input is way in the past. So instead, they're going to have to spend money that they've stored from mining way in the past, more than 100 blocks in the past, more than a day in the past. And They'll only be able to do that once before the exchanges catch on. That's one of the risks of running an exchange. So effectively, the most important thing that miners can do with a 51% attack is steal money from exchanges. That's it. Marcus asks, page 24 of this week's learning material states that the first step that miners verify that transactions are valid. How do miners do that? Well, first of all, let me clarify. It's not just miners who verify that a transaction is valid. Every node on the network verifies that a transaction is valid. Every single node. The node that I'm running, the node that you might be running inside your wallet, the nodes that exchanges are running, the nodes that wallets are running, the nodes that merchants are running. Every node that propagates transactions will verify that the transaction is valid before propagating it, meaning that you can't actually even propagate a transaction on the network unless you send it directly to a miner if it hasn't been verified. It will not propagate. The first node that receives it will not only refuse to propagate it, they will stop talking to your nodes because your node just lied to them. And this is a defense mechanism in the network. So everyone verifies transactions. So let's go to the sub-question. How exactly do nodes do that? Do they have a list of all the addresses holding Bitcoin and how many? Or do they have to search for the address wanting to send Bitcoins in previous blocks and check if it has received Bitcoins in the past that can now be spent? Both, effectively. Yes, they have a list of all the addresses holding Bitcoin. That list is called the blockchain. That's where the information is. And do they have to search in previous blocks? Yes. So this is essentially a database efficiency question. You could go searching in the blockchain and make sure that the specific Bitcoin that is being spent in a transaction has not been spent by any other transaction. Is basically check that every time you receive a transaction. That would be incredibly inefficient. Instead, what the nodes actually do is they build an indexed database called a UTXO set, which is a database for looking up the balance or the unspent coins that are available. And they can search by specific address. So as a result, or specifically in this case, they can search by the transaction hash. So they can search for any UTXO and find if it has been spent or not, because they keep an up-to-date database for that purpose, so they can do it very, very quickly. But that's simply an efficiency issue. No matter how you do it, effectively what you're doing is this. You keep a copy of the blockchain so that you can verify transactions without asking any third party. The blockchain is the authoritative record. By keeping an up-to-date copy of the blockchain, receiving current transactions and blocks, and updating all your local databases, which is the work a node does, you can verify any transaction and see if that money has been spent. And when a node verifies a transaction, they're not just looking as to whether the money has been spent before. They're looking at every single rule that applies to transactions. They're looking that the transaction length is correct, that it has the correct number of inputs, the correct number of outputs. They're checking the signatures on every input. They're checking that the money hasn't been spent. They're checking that the outputs and the inputs add up correctly and you don't have more outputs than inputs, for example. They're checking every aspect of this transaction with a long list of rules that are effectively the software implementation of the consensus rules. That checklist that every node goes through is the consensus rules as written in software. The second question by Marcus is, I've heard that all unconfirmed transactions that are not yet in a block are stored in a memory pool, which again is a database held by each node. How does a miner determine which of these transactions to include in a new block? Well, that's entirely up to the miner. They can use whatever algorithm they want to choose transactions that are in a block to include. The only requirement is that those transactions are valid. But other than that, two valid transactions may have different fees. They may have different relationships with other transactions. For example, you may have several transactions that are chained together, where there's a parent transaction that has a child that spends it, that has another child that spends it, all of which are in the mempool at the moment, in which case confirming all three together is a valid strategy. So the algorithm that is used by miners differs depending on the mining software that they're using to assemble candidate blocks and select transactions. But one thing we know from experience, and which is a natural outcome of economics, is that miners will try to maximize their profit. And on that basis, they will choose transactions that give them the highest level of fees per the weight of the transaction, so that they can stuff their candidate block with as many high fee transactions as possible and make the most possible amount of fees. How they organize transactions in the block in order to maximize their amount of fees, that's what the algorithm does for them. They may have other incentives, and they may decide to play politics, but if they do so and choose transactions on other criteria except for profitability, then they will lose money. That's the natural outcome. And for that reason, we don't really see miners acting against their own economic interests. So how do miners choose? By pursuing maximum profitability through an algorithm in their mining software that constructs candidate blocks by prioritizing transactions that give them the highest level of fees for the amount of space they take, so they can stuff that block with as much fees as possible. Jose asks, after mining a block, the different nodes will add the longest chain, or the greatest cumulative difficulty chain. How can nodes determine the cumulative difficulty of the chain? Well, you can actually do that by adding up the difficulty encoded in every block. If you think about it, every block actually shows you how much work has been done, because you can see from the hash of the block how many leading zeros it has, and that really reflects the amount of work. The proof of work, which is the hash of the block, is self-explanatory, meaning that it tells you how much work has been done. A hash that has more zeros has more work done statistically than a hash that has less zeros or fewer zeros in the beginning. So therefore, if you add up the number of zeros at the beginning of each hash, you would get an idea of how much work went into each block, and you would know which chain has the most work, the greatest cumulative difficulty. Now, the exact algorithm doesn't work exactly like that, but it gives you an idea of how nodes will know. Each block has within it proof of work. That proof of work tells you about how much work was done by the miners. It's an encoding of the difficulty, and miners know the difficulty target for each block too. And so by adding all of those up, you can get the greatest cumulative difficulty block. The greatest difficulty cumulative chain. Elizabeth asks, there are still relatively few users of cryptocurrency, but could it not become a huge world problem with all the cryptocurrency mining and their energy consumption if cryptocurrency becomes a broadly used payment system like paper money is today? Will mining of cryptocurrency without an alternative mining solution be a huge catastrophe of an energy waste? Even if green energy is used, it's used instead of supplying energy to the planet's population. Can't it also cause big problems? Elizabeth, first of all, it's important to realize that the amount of mining is not related to the number of transactions that are happening on the network, And it's not related to the number of the transactions that are happening off-chain, which is where most of the use of cryptocurrency is likely to happen, in off-chain transactions in a layer 2 network and other systems. So even if you did everything on-chain, more transaction does not mean more mining. So there's no direct correlation between the number of transactions and the number of mining. The amount of mining we have today from a security perspective is sufficient to secure the network against very large attacks by organized coalitions, even nation-state coalitions, and resist them very, very well. Now, if you want to build more economic activity on top of these blockchains, you do need more security, but that security doesn't need to increase at the same rate as number of transactions. The other important thing to realize is that energy is not a zero-sum game. The amount of energy used by human civilization is relative to the amount of human civilization, meaning that as a species, we have used increasing amounts of energy with each passing year, and that rate of energy use has increased dramatically in the industrial age. The use of electronic and paper money is not energy-free either. In fact, it consumes an enormous amount of energy, as well as physical resources like paper and cotton to produce, or plastic. With modern money, you see a lot of plastic money nowadays. Money bills made of plastic, not credit cards, but of course credit cards too. So you use not only physical resources but also a lot of electricity. So really the question is, which is a more efficient way of doing global, secure, unforgeable transactions that are on a decentralized system that can't be controlled easily by any world government? From that perspective, maybe Bitcoin is the most efficient mechanism for doing that today. We don't know yet, and we're still finding out. The other thing is that green energy isn't a zero-sum game either. In fact, if more green energy is used for crypto, it has one tremendous advantage. Crypto can be mined anywhere, anytime, day or night, at any latitude, at any longitude, regardless of how close or far away you are from a population center with demand. And what that means is that you can take green energy projects that are in remote areas that do not have steady supply or steady demand, and you can fill in the gaps by mining cryptocurrency, which then subsidizes the development of green energy. It basically reduces the cost of solar panels and wind farms for everybody else by increasing the economic incentives to build those things, because they can be utilized 100% of the time, day or night, whenever they're producing energy, even if you don't have a local population with the necessary demand. Now imagine, for example, that you're building a solar farm in a small town in a rural area. Now you wouldn't want to build that solar farm to satisfy only today's use of that town. Maybe you want to build a big solar farm that satisfies the energy of this town for a very, very long time. Maybe 5 years into the future. But if you build it now and it has excess energy, what are you going to do with that? Solar panels do not store energy, so that energy is going to get wasted. Also, you can't afford to build solar panels that produce energy that nobody is consuming. But if you also have a cryptocurrency mining system there, you can not only supply the town, you can also supply the cryptocurrency miners, which then pay for the solar panel investment, even when the town isn't using that energy. And that means that you can then build a bigger solar farm and a bigger solar farm. And the more you build alternative energy systems, the cheaper they get because of economies of scale. So cryptocurrency is not the environmental disaster that is portrayed in the popular media. That is a misunderstanding both of the means by which cryptocurrency mining happens, the reason why cryptocurrency mining happens, as well as the environmental impact of cryptocurrency mining compared to the environmental impact of alternative system of finance or other systems that our governments build. All right, I think we have time for maybe 2 more questions. Fusto says, in a general meaning, full nodes are involved in consensus for the new rules in the protocol. If new rules in the protocol violate the previous rules, then the nodes accepting blocks based on the new rule will create a hard fork in a separate chain. During the discussion about the SegWit 2x hard fork, miners were voting their intention about the fork, but this was not the consensus in the Byzantine sense. It decided the same about a rule we would expect subject to the network nodes. Who is the real owner of consensus in the case of this kind of disagreement, or in the case of a hard fork? Is it miners or is it full nodes? It's not one or the other. I talk about the 5 constituencies of consensus. Think about consensus as an emergent property that emerges from the collaboration of as many as possible participants in consensus. 1 second. All right, back to that. Sorry about my coughing. I cut that out and muted you. So think about consensus as an emergent property that emerges from the participation and collaboration of the largest amount of participants who constitute the participants in consensus. So I've identified 5 constituencies in consensus, and these are not clear-cut divisions. Someone may be operating across several of these simultaneously. So I, for example, fit in at least 2 categories of consensus already with my activity in Bitcoin. Others may fit only 1. So miners, the obvious and many think primary constituency of consensus, but their power is controlled by developers. Developers write the rules in the software, and if developers don't write the rules, then there is no software for people to run. And if developers write the rules and nobody runs their software, then their power is gone too. Exchanges. Exchanges run economically significant nodes in 2 ways. First of all, they validate all of the transactions for withdrawals and deposits for all of the users of the Bitcoin network who use exchanges, and they also provide the market liquidity for exchanges into fiat currency. Now, what that means is that if their nodes do not consider a transaction or a block valid, that's going to put enormous pressure on the consensus. They have enormous power as a result, because they don't determine which is Bitcoin, but they do determine which Bitcoin has value through the ability to exchange it in liquid markets. Merchants. Similarly, merchants won't give you currency for your Bitcoin, but they'll give you products and services for your Bitcoin. As a result, they are also operating a very large part of the economic activity of Bitcoin. If they decide they will not accept whatever coins you're mining or creating or accepting in order to give you products or services, that has enormous influence on the value of whatever coin you're mining. So they have a role, and the nodes that they operate that decide whether a transaction or block is valid are extremely important. And finally, wallets, or just plain users. The users, by choosing what wallets they run, which addresses they use, which Bitcoin they buy and sell, and which Bitcoin they accept for their own activities and services, form the backbone of economic activity. Ultimately, they feed into exchanges and merchants in terms of economic activity, and if the users decide they don't want to accept coins from a specific chain, then those coins are worthless. It's as simple as that. So, together, these 5 constituencies form the 5 constituencies of consensus. I am a user who chooses my wallet. I also run a small store as a merchant. It's insignificant, but it adds up. So I fit at least in two of these categories. And because I run nodes that are economically significant, because they actually have transactions and they inform my choices of what Bitcoin I accept as valid, those nodes are participants in consensus. Yes, it's important to run a full node to validate, but it's even more important to run a full node to validate when you have economically significant activity, because then you determine which coin is real by giving it value through your economic activity. What we see in SegWit2x and in all of the other contentious disagreements about consensus is that each of these 5 constituencies all claim to have the ultimate power, and they can continue to claim that as long as they don't try to exercise that power against the other 4. Any one of them that has tried to exercise power against the other 4 has very quickly discovered they don't have power. And in many cases with catastrophic losses, monetary losses, as a result of their hubris. So, you can be part of consensus, and you can claim you have power as much as you want, as long as you exercise that power in accordance with what everybody else's consensus is doing, the other 5 constituencies of consensus. If you try to step out of line, you're the one who gets cut out of consensus. If you don't get everybody else to come with you, you are out of consensus, and everybody else continues without you. Now, you may mine a coin, but if that coin cannot be exchanged, cannot be sold to merchants, is not recognized by the software developers, is not supported by the clients, is not supported by the wallets and users, that coin will end up very, very quickly losing its value until it is insignificant. If you write software as a developer and that software doesn't follow the rules everybody else wants to follow, nobody runs your software is irrelevant. If you have an exchange and you don't list the economically significant coin, you have no relevance. If you do list economically insignificant coins, you're likely to get scammed and have your money stolen and suffer losses as they exchange, because the economically insignificant coin doesn't have enough security. So when people withdraw that coin, you get double spent, you lose your money as an exchange, and again, you suffer losses for trying to follow something that wasn't part of broad consensus. If you are a merchant, and you accept coins that you can't exchange, and you give people valuable products and services, you will lose money. If you are a user and you put your money in a wallet that doesn't support the dominant consensus, you will lose money. If you decide to follow the wrong coin, you will lose money. It's as simple as that. Every one of the constituencies matters, and every one of the constituencies have power, but they have the most power when they walk in line with the other 4. And that's how consensus emerges on Bitcoin. That's a great place to finish. We're 3 minutes over. Thank you for your patience. Remember, this only works if you ask great questions. We had some really fabulous questions this week. The ones we didn't answer, we're going to roll over into next week and we're going to cover them. Keep asking good questions. Ask them in the forums and ask them early on, so that I can prepare good answers for you. And I will see you next week for session 3 of the 13th semester of the massive open online course for the master's degree in digital currencies for the University of Nicosia. I'm your teacher, Andreas Antonopoulos. It's been a pleasure answering your questions. Take care, everyone. Have a great week.